Now, looking at the week's performance, I mean, certainly week on week looks good. However, bearish trends on Friday, bullish week, bad Friday. What do you think was the reason for the performance we saw? I mean, you said not much reaction to Q3 results.
Thank you for having me, Uche. What we just seen is that before we had a week-on-week appreciation that you just mentioned, we had about 2 consecutive weeks of bearish sentiment in terms of market correcting itself because of the bull run that we had for like months. And it's just natural because for me, principally, it's just abnormal for the market to just keep being on the rise. But the market has to come so that there has to be some kind of realignment of interest and realignment of portfolio so that some other persons like me can come in if I haven't been in before so they can have the next rally. Fundamentally, the market is strong. Fundamentally, the market is okay. It's normal reaction to market sentiment, to market mood, to earnings. And again, but as I mentioned earlier on, the growing fear for me and analysts, some analysts I've spoken with, is the bank's earnings. We kind of see that kind of slowdown in quarter-on-quarter earnings of banks, like Q1 to Q2. And comparative period, and we're still weary. We're just trying to figure out what's happening. But there are indications that what we're seeing is some kind of those strong earnings came as a result of the way the banks were changing their loans and advances based on IFRS adoption. We've spoken with some bank MDs right investors conference calls, but we're not yet clear on that. But when we have a full year result, we'll be able to have a full perusal of it and all of that. And again, the Fitch rating and S&P rating just put Nigeria in a good stead. And as I said, maybe the Friday bearish trend is just a weekend effect.
I mean, let's talk more about those ratings there. I mean, S&P and Fitch giving Nigeria a stable outlook. What effect do you think this will have on our market going forward?
Positive effect. For the equities market in particular, positive effect. Of course, for the fixed income market, again, some kind of carrying effect. Because what you see is that the Fitch rating and S&P rating by large have the same reasons for giving Nigeria a stable outlook, be negative outlook. And the reasons are not far-fetched because of the ongoing macroeconomic reform in Nigeria, in the power sector, in the downstream sector of the oil and gas industry via the PI, petroleum industry bill, macro tightening in terms of fiscal tightening. There's no aggressive spending by government. Government is more prudent according to it. External reserve creation. And all those things just gives Nigerian economy in a better state that, okay, Nigerian economy is stable for the outlook. I mean, nothing's going to go wrong. If you put my money in here, it's going to be good for me. Now, for foreign investors, it is good for them because we had robust external reserve. And our foreign exchange policies anchored on robust external reserve position. And that kind of gives us a very good outlook. And we continue to see increasing funds coming to the Nigerian economy into the fixed income market. And that is driving yields down in the market because the market segmentation analysis, the theory that says demand and supply determines, the yield, the rate, the level of yield. Yeah. And, it's not good on the yield part. And what it makes implication is that it kind of makes the equity market attractive because when you look at it, even if we take, according to Fitch, which I believe, even if we take the power sector reform, if it goes through, imagine the enormous potential in the Nigerian equities market in terms of operating costs, operating expenses that will come down and the bottom line earnings that will
But I mean, certainly it seems like the road is clear going forward. But I mean, I will ask you, compared to historical figures, how do you see the equities market performing this time around? Of course, as we go to the end of Q4.
Historically, we normally see that as we begin to go into the later part of Q4, in terms of December, the second week of December, into the last week of December, into early January, we normally see a kind of a bull run in terms of, and it's not fair because of activities of institutional investors, pension funds, big-time players. They're just trying to manage the asset liability in the books and trying to meet regulatory requirements in terms of equity bond balances and etc. So we expect some uptick. We don't expect a major deviation. Although we've seen an early rally, which I think is not going to be lasting for too long. As we saw last week, we saw, like some 4 days of gain and 1 week of loss. So it's expected the market is usually down this time around. We expect some uptick, as you mentioned.
Okay, well, let's look more what we're going to see during the course of this week. And certainly what we saw last week, banking sector quite bearish last week as well. And I will add, Union Bank did release the results. Now, before we talk about the sector, what were your thoughts on Union Bank results? I mean, compared to 61.5 billion, a 61.5 billion loss in 2011, we're seeing PAT up to about 20.2 billion. What's your take on those results?
The Union Bank result, I think, is commendable. Given, as you mentioned, the very negative period stage where they're coming from and to where they are right now. But the market has not really fully digested Union Bank. Union Bank is still a little bit lethargy in terms of people's perception of what it is and what it can do in the future. And it's just like the result is not out of order because that's the same result the banks have been giving. You get it. But as I said again, there's a pinch of salt in those results because we're looking at those results more carefully now. We're seeing that there's a slowdown in those results for the banking sector. We're trying to look at how the IFRS adoption has impacted the result. And we've seen that most of them, the loan books have not really grown, really. And again, UBA is giving us the signal that things can go bad because UBA is telling us that they expect some exceptional kind of loss arising from treasury bill business to end the year. So we're just looking at, as I mentioned earlier on, the declining yields. Of course, these banks have huge fixed income treasury bills, FGM bonds in the books, and you know it's not good for them. You know the declining yield is not good for the books, and maybe that's just a carry-on effect. As I said, there's no full reaction yet to Union Bank result. By the time we have trading today and tomorrow, we'll see what the market really thinks of that result.
Now we're running out of time, so I mean, I'm going to ask you. I mean, with this bearish trend in the banking sector, and the FMCG sector didn't perform well. I think Dangote Sugar was the lone gainer in that sector last week at the close of last week's session. So which sector do you see driving performance this week?
Well, the same sector that has driven it for many years now, the financial services sector, dominated by the banking stocks. Of course, you cannot take the banking stock out of any market rally. You know, it does contribute to a huge proportion of market activities. FMCG, as you said as well, you know, because of the defensive nature of those stocks and because of those great earnings prospect of those stocks, good corporate action for those stocks, they will continue to compete with each other, dominated by financial services, particularly banking, FMCG, the building material, because of Dangote cement. And of course, the building materials sector, a building and construction subsector of the Nigerian economy, has drove the Nigerian economy in Q2 2012, according to National Bureau of Statistics. And of course, those three sectors you mentioned will continue to drive.